All right, I want to welcome everybody to Budget Basics, Building a Business Blueprint. We have our very own Boston business mentor, Mike Sandman, presenting on this topic. As we get started, though, I want to quickly talk to you about Boston Business Mentors. We are helping businesses start and grow and be successful. That's our goal. We do that through education, we do that through mentoring. In our education programs can be workshops, they can be roundtable networking options. And we're always looking at, and in 2026, I know we're working on new plans to interact with the business community in many different ways. So we're glad that you're here with us today. Take a look at the Boston and Business Mentor website. We do have some resources there that you can download for free. We're adding new ones all the time and working to update all that information and add more content every day. So, workshops and webinars, we will be finishing out the year with presentations this week. We have still two more to go, and then we'll be starting up a brand new set of presentations come January, and we're very excited to bring that content to you. Our workshops are free. We want you to learn so that you can be successful. And of course, mentoring is an extraordinarily important part of Boston Business Mentors. We have amazing, amazing volunteers. They have a variety of skill sets, experiences that they've learned from, so that they can share with you. They're there to be a soundboard. They're there to point you in the right direction. They're there to help you be successful. So if you don't have a mentor, reach out and get one. There's no cost. There never is a cost, no matter how many times you meet with your mentor. It's just a really fantastic program. So let's get started with building a budget. And I will turn it over to Mike, and it's all yours.
Okay, thanks, Teresa. Hi, I'm Mike Sandman. I've been SCORE mentor for, let's see, about 12 years now. And a lot of what I do is working with clients to help them build a financial projection so that they can figure out, do they have enough funding? What do they need? What are the sources of funding that they could tap into? And that's all it's all very, very important whether you're running an ongoing business or a startup. Uh, will you have will you have a profit at the end of the year is certainly an important question, but also will you, if you're starting up, will you have enough money to get through the startup period to the point where your business begins to turn a profit? And we're going to touch on, I think, all of that as we go through this. And so, why build a budget? We'll give you some definitions to remember. We'll look at what's beyond average monthly revenue. That's not the whole story. I want to talk about seasonality and the impact of seasonality on revenue. Uh, Startups require a startup budget, and we'll talk a bit about that. And then I want to talk about cash flow and a cash flow projection, which really is the ultimate budgeting tool. So as you go along, if you have a question, please put it in the Q&A. And if there's a question that relates to clarifying something I've just said, then Teresa will interrupt and we'll come back to that. We'll answer that question or try to. And if it's a question that can wait till the end, then we'll catch up with all of that. We're going to send you a fairly simple, fairly straightforward Excel spreadsheet. It will work in Excel, in Google Sheets, in Apple Numbers, and so that you can take the example that we have and plug in your own situation. So let's go from there. Why bother with a budget? Well, if you're already in business, you're making a profit, your profit and loss statement will tell you what's happened in the past, but it doesn't necessarily, or really won't tell you what's going to happen in the future, unless you work out a budget and figure out how much revenue is going to come in, what your expenses are going to be, and get some sense of what the difference is. What are your fixed costs versus your variable costs? What costs go on day after day, week after week, month after month, even if your revenue stream hasn't started up or your revenue stream varies substantially through the year. And compared to your variable cost, labor, any materials that you're using. If you're an online business, the products that you're selling and don't have to bring into inventory because somebody else is fulfilling uh, uh, the orders for you. Whatever it is, we want to make sure that you understand the difference between fixed and variable costs, and that you make sure that you aware of the fixed costs in particular uh, that continue. And what new resources might you need? Do you need more people? Do you need a space or a piece of equipment? Um, do you need more capital? Those are things that doing a budget will show you, particularly if you need more people or you need more space. How much money will you be generating in order to cover the cost of that? If you're just starting up, this becomes really even more important. Uh, if you're thinking about starting up, how much revenue do you expect to have when you first start? Maybe over the first 3 months, 6 months later. What will your startup cost be? That's a separate set of costs because to get into business, you have to spend some money. Once you start, what expenses will be fixed? What will be variable, just as we've talked about with an ongoing business? And how long will it take you to start making a profit? So we have over on the left side of the screen, we have some, you have various products and services that you may be selling. Excuse me. Those add up to your total revenue. You have startup expenses if you're starting up, website development, insurance, a rent deposit, perhaps build out for a place of business, inventory. Each new business that starts has its own set of startup costs, but that's a really important category if you're beginning. Or for that matter, if you're expanding, because in essence, when you're expanding, you have some new costs that are one time, that are startup for the expanded portion of your business. You have operating expenses that go along on a steady basis, such as rent, phone and utilities, legal and accounting. And then you have expenses, operating expenses that are uh, variable wages, payroll taxes, health insurance, inventory as you purchase it in order to resupply, to restock. So you take all of that together, and you're going to look forward. We're going to look forward for a year for a typical budget. You look forward and you say, well, what are my expenses going to be? What's my revenue going to be looking forward? All of that will add up to tell you whether you're likely to have a profit or a loss. And then you can use what you've put together to track through the year how you're doing. And that's a really important thing to do. And we'll come back and talk about that a bit. So, some definitions to remember: revenue or sales. It's what the clients or customers pay you. Um, Net revenue, which you see sometimes, or sales, is what's left over after returns or allowances or discounts. Um, Expenses are what you pay to run the business. So startup and expansion, equipment build out, legal, and so forth, as we've talked about. Fixed expenses, variable expenses, and the profit is what's left over after all the expenses are paid. And sometimes people will say, I've the business is made X amount of money, and what they're really referring to is they had X amount of revenue. The profit is what we're looking for because profit is what lets you reinvest in the business and potentially expand it. So, what are you selling? Are you selling products? Are you selling services? If you're selling those services, are you selling them on a per hour basis or per day or a fixed price? For example, if you're doing contracting of some sort, really of any sort, how do you charge your clients? Do you say, or your customers, do you say, here's the price for the entire job, or do you say, well, it's going to take me X number of days, I think, and I'll bill you per hour or per day as we go along, or perhaps a combination of both? It's important to think about what you're selling and how you're selling it, because then you have to figure out what your price should be. Um, are you selling things by the item, by the dozen, by the pallet, by the hour, by the day, by the project? Are there packaging or travel costs? Are you including shipping if you're selling a product? Um, those are all things that you need to think about as you're putting a price together, because you need to determine your direct cost or the cost of goods sold for one unit, and then determine the price that you're going to charge per unit. And a budget will help you see whether or not you've calculated that in a way that will give you a profit at the end of the year. And you have to when you're setting a price, you have to remember that you're not just covering the cost of the direct product or service that you're selling. You have overhead, you have those fixed costs, the rent, the accountant, the legal costs, and so forth at the end of each year. Okay, let's take a look at a business that has a little tiny bit of complexity to it. We're going to talk about Joe's Pizza, and the reason it has some complexity to it is that there's a place of business, so there's rent, there's some equipment involved, and some seasonality involved to the business. So let's let's assume that Joe has looks back at his profit and loss statement, and he sees that in a typical month, on average, he's had $39,167 worth of revenue from three different categories of pizza. And so he's selling pizza that people consume on the premises. He's selling takeout. He's selling delivery. He's charging extra for delivery. He's charging delivery costs. So that's a little bit of a wrinkle that he has to account for. Um, he's looking at his average monthly operating costs. Again, looking at a P&L. What has he spent on labor, on wages? And that has to, in this case, he's got a part-time manager, but it's really important to remember that he's got to include himself. So if you're working in the business, your labor, the value of your labor, has to go into that budget, so that you can pay yourself, really. And you may wait until the end of a month or the end of 2 months or whatever, and see how much money is in the till, so that you can pay yourself some cash out. But however you do it, on a monthly basis, you should be allocating your costs as well as the cost of um, any other labor. So Joe figures 20% of what he's going to take out of the business. Sorry, what he's going to take out of the business, plus he needs labor to cover an amount equal to roughly 20% of his monthly revenue. And his monthly revenue may go up a little bit higher in some months and be lower in other months, and he can expand the number of people that he has by um, one or two people, or half a person, or perhaps get one of his people to work some extra hours in order to cover that time. But generally speaking, there's a relationship between the total revenue and the labor that he needs that he can more or less estimate as 20% of his monthly revenue. He has to pay payroll taxes, and that's more or less 12% for Social Security, Medicare, unemployment insurance, workman's compensation insurance. There are some very specific numbers that you can plug in. If you use a payroll service to do your payroll for you, then they'll take care of all of that and make sure that the payroll taxes get paid. It's really important to pay those payroll taxes. He's only covering health insurance for himself and his family. He's got a small operation. He's not required by law to provide additional health insurance. If he had um, more employees, then he would be required to at least make a contribution to their health care costs. But in this case, he's not doing that. Food supplies amount to 18% of his revenue. Beverage supplies, 10% of his food revenue. Pizza boxes, couple of percent. That box is not free. Delivery fees, um, and he's passing some of those on, but he's also has to pay he's getting the revenue in his price, but he's got to pay the delivery organization, whichever it is, or his driver if he's delivering himself. He's got rent. That's a fixed monthly expense. Typo in there. Uh, Phone and utilities, maintenance and repair. Important thing to remember, something always is breaking. Um, Liability insurance, he's being charged $180 sorry, 18 $180 a month, but he's paying it quarterly, as we'll see from his budget. He's has an internet, a website, so that people can order and see the menu and so forth. And he has an accountant who does his tax returns at the end of the year, and a bookkeeper who's helping him keep all this straight, and that averages $323 a month. Uh, and so his total operating costs on an average monthly basis are 36,300, and his average monthly profit has been $2,836, just revenue minus operating costs. Whatever business you have, you need to think about each and every one of the operating costs that belong in your budget. And if you've been in business and you have a profit and loss statement, an income statement from an accountant or a bookkeeper, somebody perhaps who's using QuickBooks, all of this will be available. You can just pull it right off of that. If you're starting up, then you have to think about, well, what are my costs going to be? Hopefully, you've had some experience in the business or talked to some people in the business so that you will know what each one of those categories are. You have to make sure that you catch them all because otherwise, in your projections, you'll be off by the amount that's missing. Okay. Uh, Revenue. Most businesses selling to, and seasonality. Most businesses selling to consumers and some business to business operations experience seasonal highs and lows. So the extreme example of a seasonal business is Christmas trees. Okay, once you get past December 25th, uh, well, if you've got Christmas trees left over, sorry, you're not going to sell those. And there'll be no further business. If you're raising Christmas trees for sale, you know you've got a whole year in which to, or 11 months in which to raise the trees before you begin to get revenue in. So that's the most extreme example. Not so extreme, florists, they do a lot of business on Valentine's Day, on Easter, on Mother's Day, and excuse me, not so much on in on other days, and so their average revenue will vary month to month, going up quite a bit in February, going up quite a bit in April and May. Vacation rentals, including Airbnb, package stores, their their revenue tends to be clustered around holiday times. So vacation rentals, obviously, if it's a summertime rental on the Cape or Nantucket or someplace like that, the heavy revenue season is going to be in the summertime. The rest of the year will be quiet or perhaps completely dead. Package stores do a very substantial part of their business around this time of year. People buy alcoholic beverages as gifts and to drink around Christmas time. And it used to be, in fact, that package stores really didn't make a profit until the Christmas season came along in a typical year. Less obvious, Joe's Pizza, and perhaps your business too. So I've gone through all of this to say that think about your business and the seasonality of the revenue curve in that business, because when you're doing a budget, you need to do it month by month in order to look at what your likely revenue and expenses and profit are going to be individually month by month so that you can do a cash flow projection and make sure that you've got enough money to cover your costs during the down months, during the months that not a lot of money comes in. And we'll go through an example of exactly how that works at the end of this. But that's the basic principle. You want to make sure that you understand enough about your business and the flow of revenue and costs so that you know that you have enough money during down periods that comes from the up periods to get through those down periods. Okay, there's a whole lot of numbers on this sheet. All right, but uh, let's take it one step at a time, and I think by the time we get through this, you'll see where we've gone with it. So Joe has, as I say, he has eat it here, take it out, or delivery. And this is what he sees in a typical year. January, February, March doesn't have a lot of people walking in. It's cold. Uh, he may have some takeout order, but he'll have a lot of delivery. Okay? And in April, May, June, July, people come in. The weather's a little better. There's some takeout business that goes along. The summertime, there are some pizza parties especially for takeout, and his delivery business kind of drops off a little bit. And in August, Joe goes on vacation for 2 weeks, so his revenue takes a big hit. But he goes out on vacation in August because he's just had a bunch of money come in and he's tired from July and he's going to take a vacation sometime. So he does it in a month when he knows that there's going to be typically a slight dip in business. So his revenue drops very substantially at 24,000 from 50,000 the previous month. And in September, he's expecting, based on his prior experience, that business will come back up to $18,000 for Eat It Here and 16 for takeout, 14 for delivery. And so you see the variation from month to month. 33,000 in January. He hits a high point of 50,000 in July, a low point of 24 in August, and then a high point again at $59,000 when there are office parties and so forth. And he does a really big delivery business. So that's Joe's seasonal look. And each one of his product lines has a different seasonality to it. And I think that's important to remember if you have multiple product lines that have different seasonalities. When you're putting your budget together, forecasting what you're going to see for revenue, each one of those lines should be looked at separately based on your experience, based on your knowledge of the business, based on what you expect uh, for the coming year. And altogether, Joe expects to have $470,000 worth of revenue, and dividing that up by 12, that's where we come up with the $39,000 and some change of average monthly revenue. His operating costs also vary. So his wages, remember, he's got himself and a part-time manager, and then his wages will go up and down a little bit depending on whether he expands hours for his employees or contracts them based on the amount of business that he's doing. And his wages go along pretty steadily. His he Joe does not pay vacation pay, and so his wages go down substantially. Wage costs go down substantially in August. Still got to pay himself and perhaps his part-time manager. And in December, in order to cover all of that pizza making, his employees will work some extra hours, and so he ends up with more hours. But he also pays a bonus out at the end of the year, and so Joe's December wages are a substantial bump above the average line, and he knows he's going to pay that bonus in December, so he puts that cost in there. His payroll taxes are just a fixed amount, 12% of the wage cost, and that carries all the way across. So he's paying $200,000 out for wages in total, and $24,000 and some change out for payroll taxes. His health insurance, he's got a health insurance policy for himself that carries all the way through. And food supplies vary. That's a variable expense that obviously varies depending on how much pizza he's making. So he's got $5,940 worth of food expenses in January when he has $33,000 worth of revenue. But in July, he's got $9,000 worth of food supplies and 10,620 in December when he's got all that extra business. So that's a classic variable expense for a business like his. Beverage supplies, same thing. That's 10% of his revenue, more or less. You can see there it is, $3,300, $4,200 on 42,000. So that's his projection. And the numbers that he actually gets will differ a little bit, but that's what he expects based on his experience and sort of rounded to a reasonable approximation. Pizza boxes, same deal. Again, a variable expense. Delivery fees, same thing. Here is a fixed expense, is rent. He has to pay $2,000 a month. Doesn't matter whether he's selling $33,000 worth of pizza or 24,000 or 59,000. So that's a fixed cost, and it goes on every single month, along with phone and utilities, which go up down a little bit. Not sure why his utilities go down here. Maybe he's not running the air conditioning as much. Maintenance or repair, he figures $3,000 over the course of the year and just spreads it out. As a practical matter, that projection won't, even if he spends $3,000, more of it will be in one month and less of it in some other month, but he averages it out over the year. His liability insurance, he knows that he has to pay that on a quarterly basis. So 540, 540, and so forth. Internet hosting is a constant expense, fixed, and legal and accounting expenses. Well, he pays his accountant to do his tax returns in April, but he pays his bookkeeper 200, his part-time bookkeeper $240 a month to do the books. And so he knows that it's $240 plus the $1,000 that he pays in April for his tax return, and then it goes back down to $240 through the rest of the year. So his operating costs vary quite a bit. $31,000 in January, he makes a very small profit in January, and an even smaller one in February because his business went down a little bit. But when he gets to June, he's making $9,000, and in July, $10,000 because he's got that much more sales. And okay, these are fixed expenses up here. His payroll taxes, sorry, his health insurance, food supplies, and so forth. But they go up and down with with the amount of business that he does, but the fixed expenses don't change, and so he's got more revenue to cover those fixed expenses. His profit goes up disproportionately in that month, and that's an important concept to make sure that you understand. That's a perfect example of scaling the business. The more revenue he can bring in on top of the fixed cost that he has, the better off he's going to do. He's going to make $10,000 in July. When he goes on vacation in August, he's going to take a big hit. He hasn't got enough revenue to cover his wages for himself and his part-time manager, and the little bit of variable expenses that he has, and all of these fixed expenses. So he actually loses a little bit of money in that month. In September, it comes back to life, and he does pretty well through the rest of the year, and he expects to make $34,000 at the end of the year. So he plans to pay out $6,000 in bonuses before Christmas. That's why his labor costs are up here. Otherwise, it would be 19,800 as a function of this $59,000 worth of revenue. Okay, let's take a breath. Think about this this whole great big year. What we've done is break out the various product lines or the various service lines if you're selling a service. Figure out what the seasonality is for each. Make a reasonable projection for each month. Add it all up. Do the same thing with labor and the same thing with variable costs. And a portion of his labor is, of course, a variable cost, and a portion of it is fixed. That's him. And then look at the fixed cost that we have, and you put that all together, and that gives you a projection month by month of what your profit should be. And that's a look forward. I'll look back, but look forward. It may be identical to his profit and loss statement from the previous year if he feels like nothing has changed. Although I would always suggest rounding some numbers as opposed to using the exact numbers. But that's going to give him a good sense of what to expect each month. And if he finds that at the end of a particular month, even though he has $49,000 worth of revenue in June, his profit isn't as high as that. He needs to be thinking about, well, what's happened in this expense line? Where's my money gone? What else has he had to spend it on? And on the other hand, if his profit is higher, then he ought to think about, well, why is that? There were some expenses that have been postponed from 1 month to the next. Okay. Um, Now, the pizza shop example is it's just an example. Your business is different. The principles are the same. So again, go back, look at your various types of product or types of sales. Think about the seasonality, how things go up and down during the year. Include everything you need to start by if you were starting a pizza shop in order to sell your product or service. And remember that it takes time to get that first sale and time to build up to a sustained level, and you have to plan for a startup lag. So that's where a startup budget is going to vary from a budget like we had for Joe's Pizza. If Joe was just starting up, think about the consequences of that on his revenue line. So let's do that. So uh, when he's starting up, he starts up in January. He starts renting the store, paying for rent. He's got some build out to do in the store. He's not selling any pizza at all. Zero. Revenue is zero. And then as people begin to get to know him, they start to come in, and his revenue gradually builds up until by June, July, it looks an awful lot like or exactly like in this case, what his sort of going concern revenue was looking at the previous sheet. So let's just go back and look at that previous sheet and see where we are. It's in July that he gets up to the expectation that he has for um, his existing business. Let's say he's starting a new pizza shop somewhere else. He's figuring that by July he'll get up to that same level in that new business. If he didn't have any pizza shops at all, if he was starting from scratch, then the startup budget would be the only thing that he'd have. But in any case, you can see that his revenue builds up slowly. And therefore, his wages, he's paying himself. He doesn't actually have to hire a part-time manager until he gets a little bit further into things. Um, but he does have to pay himself because he needs money to live on. And he's got to pay payroll taxes for himself and cover health insurance. And he's got to cover rent and the other fixed expenses, even in a month when he has zero revenue coming in. So he's got a loss of $13,645 from all of these things because there's no revenue whatsoever to cover it, and that begins to change in the next month. His loss goes down, and it goes down further, and then in May he begins to make a small profit, and again by July he's back up to where um, he would expect to be on a monthly basis in a business that had been around for a little while and had a track record. He's still going to take that vacation in August, even though he's just starting up. So at the end of the year, Joe is expecting to make $24,000, and his revenue is 412,000. It's quite a substantial drop from the revenue that he would have had on an ongoing basis in the prior spreadsheet. Okay. So how about his startup costs? What does it cost Joe to get into business? And again, this will vary depending on the kind of business that you've got. And I'm quite sure that I've never been in the pizza shop business, so I've taken some scientific wild ass guesses at what some of these costs might be if he took over a space that was already or had been a pizza shop. If he was building it out from scratch, probably he would have more expense. So he's got website development. Piece of advice. Sometimes people will say, well, I can get websites developed for me by going offshore. Be very careful about that. The experience that I've had myself with going offshore and not for website development, but for some internet research and other people have had for website development is that the developer needs to understand something about your business. Uh, and that's not always the case if you go offshore to a supplier in another country with a different culture. So leave that little bit of advice aside. Website development, it's going to cost him $750 for a bare bones website to get himself started. He's got an incorporation fee. He's setting up a limited liability company online at the Office of the Secretary of State. That's the fee from Massachusetts. Other states will vary. He's got a rent deposit. He's got to provide the uh, first and last year's rent, the current rent. Um, Actually, that's a couple $1,000s higher than those numbers, so he may be overestimating that. He's got restaurant build-out costs. He should get quotes ahead of time for labor and materials before he embarks, before he signs that lease in particular, so he knows what it's going to cost him to build out that restaurant. Same thing with kitchen equipment. The cost would be higher if the space hadn't been previously used for a restaurant. If you're familiar with the food services business, you know that you always want to go into space that somebody else has been doing food service in previously. Restaurant sundries, boxes, paper goods, utensils, napkin dispensers, salt, pepper shakers, all the stuff that people expect to have when they walk into the pizza parlor costs some money. It's a startup cost. He needs to buy a point of sale terminal, get some additional food inventory supplies in and beverage supplies. And so that's his total startup cost, $65,000. But wait a second. If we go back, we see that Joe had a loss in January and February and March and April. So he hasn't got enough revenue to cover those costs. How about his startup costs? And the answer is if he's doing a startup cost and a proper budget projection, he'll know how much money he needs to have available right from the beginning before he starts in order to cover all of those costs and not run out of money before he gets to the point where the business is making a profit. It's great to say, oh, look, after 6 months, I'm going to make $10,000 a month. But if you don't have enough money to cover those initial expenses that first 6 months, you won't get there. You'll have to close up before that because you won't be able to pay for all of the things that you need uh, uh, until you get to the past that break-even point, past the point where you've covered all of your losses and you're able to make more money in the aggregate and as a more cumulative profit than your expenses were. So those are his startup costs. So let's look at his cash flow projection. What he really needs to do is have about $100,000 available in cash when he starts this business. So why is that? Well, he's got all of these costs. Remember this, he's got no revenue and $13,645 worth of loss, and he's also got to cover the cost of opening the shop. And that $65,000 from the previous spreadsheet is in there. And so he's got about $79,000 worth of total costs. And if he has $100,000 in the bank to begin with, or $100,000 available, he doesn't have to have it all available that month, but he has to know that he can access it over this next few months. He's only going to have about $21,000 left. So he's got $21,000 left at the beginning of February. He's got a little bit of revenue coming in, $11,000. He's got $19,000 worth of operating costs, and he's got a loss of $8,000. So those are his total costs. The revenue, the less the operating cost, that's his profit. Those are his total costs. His ending cash is going to be only $13,000. And the next month, the same thing. Okay, he's got $19,000 worth of revenue. That's beginning to look pretty good. But he's still got a loss of $4,300 because his operating costs are not being fully covered. His startup costs are gone. You can see that's all paid for in the first month. But his other costs remain. Uh, Fixed costs are in there all the way through, and the variable costs are in there based on the amount of business that he's bringing in. His ending cash goes down again. It goes down by that loss, 43.56. It goes down to 8,500. And then it goes down a little bit, another $1,200 down in April. And finally, in May, he begins to make money. So his ending cash goes up a little bit. So you could say, well, Joe didn't really need $100,000. What he needed was $96,666. But that's zero margin. That doesn't give him any breathing room at all for bad weather in April or something like that. So $100,000 is nice. It gives him a little bit of a cushion. And it's a good idea to have something on the order of 10% of what you actually expect your startup, sorry, your startup expenses are going to be. Sorry, your total cash needs are going to be. Um, and so here you can see he gets back up, and again has that loss in August. Let's see what that does in a graphic form, and then we're going to come back and look at this, take a breath, and go through it again. Um, oh, there's something missing here. Here, sorry. This is an important slide, and I don't know where it's gone. Hang on just a second. Take us off sharing for a minute. Just give me a second. Slide here that I want to show. Important one. Here we go. Second. There it is. Okay. Uh, Sorry for that bit of confusion. I'm going to show you a PDF here. Explain what I'm talking about. Okay. So we talked about Joe's revenues gradually building up as he's starting up his business over the year. We talked about his operating costs right off of that previous sheet that we were looking at earlier. And we talked about his profit being negative in the first 4 months. This is his cumulative profit. So $21,000 of loss between these 2 months. $26,000 worth of loss between these 3 months, 27 and 20 down to 24 after he begins to make a profit in May. And then his cumulative profit loss gradually comes back up so that he's actually, for the year, making a profit by September. So this is his break-even curve here. His cumulative profit and loss comes up to break even, to zero, in September, even though his revenue has come way up here, and his revenue is now covering his costs by the time he gets to the end of April. This is a concept that I think a lot of people have a tough time getting their heads around. His profit comes up to positive. He's making money in May, but he's still, for the year, substantially in the hole. And he doesn't really come up to a break even for the year until there. So that's an important concept, an important point to remember. Your your profit for the first year when you're starting up isn't going to get to be positive until some period after the time when you're making money on a monthly basis. He's making money on a monthly basis back here in May, June, and July, but his cumulative profit for the year is still negative. And so uh, he needs to wait a while before his profit gets back up. And at the end, it'll total $24,892. That's his projection anyway. Um, but it takes him 9 months to get there. So um, we've talked about seasonality. We've talked about how you have to build up if you're in a startup mode. You have to build up revenue from zero. You don't get your average revenue right away. You don't go from zero to the 39,000 dollars worth of average revenue. Um, and similarly, your profits will take an increasingly heavy hit through the first several months, and then hopefully they begin to come back up, and you'll get to a break-even point. So let's go back to the other presentation now, so that get back to those numbers. There we go. Okay, so again, let's take a breath and think about this thing. Um, you've got the revenue that gradually builds up, the operating costs that increase as the amount of food that goes out the door, the pizza that goes out the door increases, the profit that gradually gets back under control and comes up to a reasonable number at the end of the year for a startup, and his ending cash if he starts with that $100,000. If he only starts with $80,000 available to him, he's going to run out of money here. He's going to run out of money right here. And actually, it's going to run out of money right here in February. And so you really have to calculate this pretty carefully if you're doing your startup. Similarly, if you're expanding, uh, you need to think about, well, what are my expansion costs going to be? They are just like startup costs. And you need to plug those in order to figure out what that expansion is going to bring you in additional revenue. You may have an existing revenue stream, but you should be calculating separate projection for the expanded portion of your business. Okay. So existing businesses, if you work in the business, the cost of your labor belongs in the budget. That's something that I want to emphasize. All of your costs need to be included, whether you pay them daily, weekly, monthly, annually, whatever they are. Um, don't forget licenses and permits. That's something that people sometimes forget. Food service is an obvious one, but there are almost any business that you're in, there are some licenses and permits if you're building out and doing some kind of construction work in a facility, in a storefront or something like that. You need a building permit, or the contractor needs a building permit. Seasonality affects revenue, as we've described, and therefore it's going to affect profit and cash flow. And for startups, so we've done a 1 year projection. You want to project forward 2 years or more, particularly if you're asking a lender to give you some money, whether it's your Aunt Susie or a nonprofit lender uh, to to give you some money so you can get started. You want to be able to show them that it's not just 1 year, but 2 or 3 years of decent projections and a reasonable profit. Cash flow, that last thing that we did, is the key to understand what you need to survive that startup lag. So we looked at $100,000 worth of cash need at the very beginning. Maybe he got that from Aunt Susie, and she'll pay him as he needs the money. Um, or he'll get a loan that he can, or a line of credit that he can draw on from a nonprofit lender um, that will cover that, but he has to have that in place ahead of time. And so before he commits to starting, he has to get quotes. He has to know how much money he's going to need. He has to know where it's going to be coming from. Check out the regulatory requirements with regard to licenses and permits. Usually, for every type of business, there is an attorney in town who will specialize in that type of business. I sat on the Brookline uh, licensing board for a couple of years, and there was one attorney in particular who came for almost every restaurant that came to Brookline, that opened up in Brookline. She was the expert on understanding what permits they needed and what requirements they had for the health department and so forth. And she provided that advice, and she would appear on their behalf at the licensing hearing. There's somebody like that pretty much for any business that needs permitting or has to conform to regulations. And seasonality will affect a startup as well. So budget is a tool, whether it's a startup projection or you're working off of a P&L from last year. Update it, use it to look both forward, how am I likely to do, and back, how did I do, and what do I have to tweak in this thing? It's an Excel spreadsheet. You can change the numbers, and the forward numbers, the numbers for the future, will change right along with that. And so you'll be able to get a sense of what's coming at you, whether you're going to have a higher or lower profit, whether you're going to have a better or less successful year than you were hoping for. Okay, that's it for the slideshow. Let's take some questions.
I don't have any questions submitted right now, but certainly if anyone wants to throw some questions in there, we can get those answered. They can go into chat, that's fine.
Okay,
And just while we're waiting for letting people type, like you said, we will be sending a follow-up email with the recording and the Excel file you mentioned
great.
for everyone's use. And
And I
yeah.
see there's something in chat from Claudia that the Secretary of State has now tacked on a $20 convenience fee, um, which is something I hadn't realized. I put an LLC together a few years ago, and they didn't have that. So obviously, it's really $520. That's
Yeah, would you mind rolling to the next slide so that everyone has access to the QR code should they want to get a
sure. There
mentor?
you go.
Yeah, there's the QR code there to request a mentor. It'll take you right to the website. If you can work one-on-one with somebody on budgeting. We have a handful of mentors that can work with you on this topic to help make sure your budget is in good shape for your goals. So, okay, well, I guess we're not going to have any questions. So.
Okay.
But they know you know you can reach out to us. You see our email on the website or on the screen right now, and we're here to help you out when you're ready. Thank you, everyone, and thanks, Mike. Oh, wait. Let me see what this one in the Q&A is. Say after your business is established and wanted to start savings, does it just become a box on the Excel sheet?
Yeah, if you want to set aside a cash reserve, yes. Yeah.
Okay,
Yeah.
that's an easy enough question. Okay. All right. Well, thanks, Mike, for your time today. And thank you all for joining us. And we hope to see you again at a new presentation. And if you didn't see, we are doing all different financial reports tomorrow. So if you haven't signed up for that, you might want to. And we'll hopefully see you in the future. Thank you.
Thanks. Bye-bye, folks.